By 2023, China has firmly established itself as a global leader in electric vehicles (EV) production, controlling nearly 60% of the market. This surge in EV production is not simply a result of China's large-scale manufacturing capabilities, but also a product of the state-backed policies that heavily subsidize EV manufacturers. Additionally, China has a near monopoly over the vital raw materials used by EV production, such as lithium, cobalt, and nickel, which are essential for the batteries that power these vehicles. The Chinese government's control over the resources gives its companies a massive advantage in reducing production costs. In addition to subsidies, Chinese firms like BYD, NIO, and Geely are thriving in the EV market by offering cars at prices that are far lower than those of the American counterparts. For example, BYD sells an EV for around $15,000, which is about half the price of a typical electric vehicle sold in the United States. Such a low price are partly a result of lower labor and production costs in China. These companies have established themselves not just in China, but also in overseas markets, aggressively exporting EVs to other countries. This strong push has made Chinese manufacturers fierce competitors to giants like Tesla, which has long been the leader in EV market. In response to China's increasing dominance in EV market, the Biden administration imposed 100% tariffs on Chinese-made electric vehicles in 2024. The goal of these tariffs was to protect U.S. car manufacturers and give them a fair chance to catch up with China. The idea was to make Chinese EVs more expensive in the U.S., thereby encouraging American consumers to buy domestic models. However, Chinese manufacturers have been able to find workarounds by shifting their production to Mexico. These companies have leveraged the United States-Mexico-Canada Agreement, a trade agreement that allows duty-free access to the U.S. market under certain conditions. This move has allowed Chinese firms to avoid the tariffs and continue selling affordable EVs in the United States, while the United States government has made efforts to subsidize the purchase of electric vehicles through the Inflation Reduction Act, which offers tax credits and incentive for consumers. These efforts are not enough to fully counter the Chinese supply chain advantages. The U.S. continues to struggle with soaring raw material necessary for EV production at competitive prices, while China controls much of the global supply of these materials. The trade war between U.S. and China, which began under former President Donald Trump, has had lasting effects on both country economies since 2018. Trump imposed tariffs on over $370 billion worth of Chinese goods, including steel, aluminum, and high-tech products. China retaliated by paying tariffs on U.S. agriculture products like soybeans, pork, and machinery. This resulted in a loss of $27 billion in exports for the U.S. farmers between 2018 and 2020. Even after Biden took office, many of the tariffs were initially imposed by Trump remained in place. These tariffs were made it more expensive for U.S. manufacturers to obtain raw materials from China, which has resulted in higher production costs. The study conducted by Peterson Institute in 2023 found that the U.S. firms have absorbed 92% of the costs from these tariffs. As a result, U.S. companies have become less competitive in the global market as foreign manufacturers can produce similar products at a lower cost. The impact of U.S.-China trade war has been particularly damaging to several critical industries in the United States. In 2022, the U.S. imposed restrictions on the export of advanced semiconductor chips to China. The goal of this policy was to limit China's ability to use these chips for military purposes such as artificial intelligence and surveillance systems. However, this has also hurt the U.S. companies that rely on selling these chips to China, such as Intel and Nvidia. The semiconductor industry in the U.S. has seen a significant loss of revenue, mounting to $70 billion annually. The retaliation China banned of sales of Micron chips, another major chip maker, within its borders. This has led to a decline in the global trade and worsened the supply chain issues faced by many tech companies. China is a key player in the clean energy industry, producing 80% of the world's solar panels. The US has responded by imposing tariffs on Chinese solar products to prevent dependence on a country that has been accused of using forced labor at regions like Xinjiang. These tariffs have caused a 30% increase in the cost of solar panels in the US, slowing the growth of renewable energy products. This is now struggling to catch up to China's dominance in solar panel production, which has made it more difficult to meet clean energy goals. Another area where China's dominance has affected the United States is in the steel and aluminum production. China produces more than 100 million tons of steel per year, which floods the global market and drives down prices. To protect the US steel producers, the US has placed tariffs on 25% on Chinese steel and 10% on the aluminum. While these tariffs help the US producers, they also raise the cost of industries that rely on these materials, such as automakers and construction companies. In an attempt to reduce the dependence on China, the US has promoted a strategy known as the free upshoring, which involves sourcing critical materials from countries with shared values rather than from China. However, this strategy faces significant challenges. For example, 90% of the rare earth metals which are essential for producing electronics, EV batteries, are still controlled by China. This means that the US companies are still dependent on China for these key materials, which raises costs. The price of EV batteries in the US is currently $138 per kilowatt an hour compared to $90 an hour in China. The US also faces challenges from the World Trade Organization. China has filed 21 complaints against the United States tariffs, and if the World Trade Organization rules against the US, it could undermine the legitimacy of the US trade policies and make it harder for the country to protect its industries in the future. China's state-driven industrial policies, coupled with the US protection measures, have created a fragmented global economy. While tariffs are designed to protect certain US industries, they have also raised costs for others, making it harder for American businesses to stay competitive. At the same time, China's focus on sectors like electric vehicles, semiconductors, and clean energy has allowed its companies to innovate and grow, leaving the United States struggling to catch up. The future of a global economy will depend on finding a balance between protectionism policies and investment in domestic capabilities to remain competitive on the world stage. The global competition between China and the US for leadership in key industries like electric vehicles and tech continues to evolve, while tariffs and protectionism try to defend America's interests. China's aggressive strategies are pushing forward. The future of the global economy is uncertain, but it will be defined by how well both nations balance protectionism and investments in their domestic industries.